Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Reckitt stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Some people refer to Reckitt as Reckitt Benckiser. This is a consumer goods company. It makes health, hygiene, and nutrition products. Its brands include the sore throat medicine Strepsils, the Canadian hair removal product Veet, the immune support supplement Airborne, the antacid Gaviscon, the baby food brand Mead Johnson, the air freshener Air Wick, Calgon. They also make Clearasil. This is a well-known skincare and acne medication. Durex condoms, Lysol, which is popular in the US, Mycil to treat athlete's foot, the stain remover Vanish, KY jelly, and many, many more products. J&J Colman was founded in 1814. Benckiser was founded in 1823. Reckitt Sons was in 1840. In 1938, Reckitt Sons and J&J Colman merged. The company we're looking at was formed in 1999 by the merger of British company Reckitt Colman and Dutch company Benckiser. The company is headquartered in Slough, UK. It trades on the Pink Sheets, Deutsche Börse, Mexican Bolsa, Xetra, Swiss, and London Stock Exchange. We are looking at the ticker that trades on the London Stock Exchange, so all the numbers in this video are in British pounds. Let's get started with the model. This is a large cap company, 44 billion pounds. They're trading at 62 pounds a share, and they have 714 million shares outstanding. The dollar amounts on the British Stock Exchange are in pence, not pounds. That means the stock is trading for 6,234 pence, which is the same as 62.34 pounds. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So they do generate lots of free cash flow. It was low in 2019, but still close to 1 billion pounds is a lot of money. And it was over 3 billion in 2020 during the height of COVID. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's a bit volatile, negative, positive, negative, positive. Revenue is the sales for the company, and that grows from 12.6 billion up to 14 billion. It did drop in the trailing 12 months to 13.7 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. The cost to make the product is part of cost of revenue. Revenue minus cost of revenue gives you your gross profit. And that was highest in 2020 at 8.4 billion. It's currently 8 billion. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue. Examples are payroll for support functions like HR. Below that is their operating income, which was lowest in the trailing 12 months at 2.9 billion pounds. It was highest in 2019 at 3.3 billion pounds, but it's pretty consistent year to year. They paid 194 million pounds of interest on their debt, which is lower than prior years. Below that is their pre-tax income, then their taxes, and the bottom line of the income statement is their net income. The reason it's negative in 2019 and the trailing 12 months were large non-cash write-offs, like asset impairments and goodwill impairments. It's better to focus on operating income when looking at the income statement. That's a better indicator of how the company does. This is the income statement from their annual report, 2019 and 2020. They don't provide complete financial statements for interquarters, only their annual financial statements. Revenue increased from 13 billion to 14 billion. I like investing in companies that can sell their products all over the world and they're easily scalable. This company fits both those descriptions. They had sales of 800 million pounds in the UK, 4 billion pounds in the US, 1.6 billion in China, and 8 billion in all other countries. Here's a breakdown of their revenue by product line. Hygiene is 6 billion, health is 5 billion, nutrition 3.3 billion. The margins in hygiene are 26%. The margins in health are 27%. The margins in nutrition are 14%, so they have the lowest margin. Margin is just operating profit over revenue. Here are some products in their hygiene category. Air Wick is in hygiene, KY Jelly is in the health category, and Airborne is in the nutrition category. Below revenue is the cost of sales. That was £5.6 billion. Then below that is their gross profit, which is £8.4 billion, up from £7.8 billion. Below that is their net operating expenses of £5.3 billion. And you could see the reason they had negative net income was this large impairment, $5.1 billion in 2019. It was $1 billion in 2020. So their operating profit was $2.2 billion. Last year was negative $2 billion. But you'll see they generated sufficient cash flow in 2019 because impairments are non-cash items. They spent £363 million of interest on their debt in 2020. That was $314 million in 2019. They had financing expenses of $286 million. This is just a different way to take on debt. Their pre-tax income was $1.9 billion. Last year was a pre-tax loss of $2.1 billion. They paid $665 million of taxes because asset impairments don't help your taxes. If they lost $2.1 billion from their day-to-day operations because their expenses were too high in their production facility, for example, then they would get a tax credit. But since the loss was due to an impairment, they don't get the tax benefit. They had net income of £1.2 billion. Last year it was a loss for £3.7 billion. That includes discontinued operations. Discontinued operations are parts of the business that have been divested or shut down. So the operations that generated this £898 million loss didn't appear in the 2020 numbers. The operation that produced this gain of $50 million won't appear in their 2021 financials. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So 2020 was a great year due to COVID. Demand was really high, and they generated £3.5 billion of cash flow. It's still pretty high in the other years. $1.4 billion is a pretty good number. That's the cash left over after paying all your day-to-day expenses. They invest a lot of money in CapEx because they do a lot of manufacturing. CapEx are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. They use their free cash flow to pay a dividend. It also looks like they've been using their free cash flow to reduce their debt load. In the trailing 12 months, they added $500 million of debt. They paid down $1.7 billion. So they reduced their debt load $1.2 billion. In 2020, it was $1.6 billion. In 2019, they added $400 million of debt. In 2018, they reduced their debt $1.6 billion. That's another way to help investors by reducing debt. Because when you reduce debt, you reduce the interest payments on your debt, which means more money flows to the bottom line. This is the statement of cash flows from their annual report, 2019 and 2020. And the top part is cash flow from operations, then cash flow from investing, then cash flow from financing. And the way you calculate operating cash flow, you start with your net income or net loss. Then you have to add or subtract the non-cash items on the income statement and adjust for changes in working capital. And we add back that asset impairment of $5.6 billion, because that's a non-cash item. That's how they generate a positive cash flow, even though they reported a big loss. In 2020, we start with £2.2 billion. We add back $1.5 billion of depreciation, amortization, and impairments. These three lines are the changes in working capital. Then the cash adjustments for interest and taxes. Because companies use accrual accounting on their income statement, the operating cash flow section is converting net income from accrual accounting to cash accounting. Even though they reported an accounting profit of $2.2 billion, they actually generated $3.5 billion of cash flow. They invested $400 million in PP&E. It looks like they acquired another company, and that resulted in $92 million of intangibles. Because the only way you could purchase intangibles is through an acquisition. You can't just sell intangible assets or buy intangible assets from someone. You can buy someone's business, and as part of that sale, intangibles come along with it. Or you can sell your business, and part of that sale is intangibles. They spend £500 million in their investing section. In their financing section, They took on £3 billion of debt. They paid down £4.6 billion. They paid £1.2 billion of dividends. In their financing section, they had a cash outflow of $3 billion. Last year was a cash outflow of $800 million. Let's look at the capital structure. $7 billion of equity, $11 billion of debt. They're 38% equity, 62% debt. And I gave them the middle whack on Finbox, 6%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year, for that $62 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of £55 billion. We divide that by 714 million shares. And we get a calculated stock price of £77. They're trading at £62, so they're trading at a 19% discount. It's a buy according to the model. Their revenue is projected to increase 2.3%, so I increased their revenue 2.3% for the next 4 years. That's how I got their future revenue estimates. To get their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. I summed up these 4 free cash flow numbers and I divided by these 4 revenue numbers. And that comes out to 14%, so they convert 14% of their revenue to free cash flow. I multiplied their future revenue estimates by 14%. That's how I got their future free cash flows. Simply, Wall Street's valuation is £80, so they're saying it's 22% undervalued. Here's where the stock has been trading the last 2 years. The stock market reports the numbers in pence. So it's currently at 6,300 pence, which is £63. There's lots of volatility on this stock. Look how big this wick is. The stock was trading over 8,000 pence and it closed at about 6,500 pence. That's a lot of volatility for one day. The stock bottomed out in March 2020 when the market crashed from COVID. Then the stock shot up because there was so much demand for its products. And I think since it came up so much so fast, there was a big sell-off. And there was tons of selling activity at this point. It closed at about 5,500 pence. It's up about 10% from that point. The stock crashed at the end of July when the company announced that its margins may be squeezed due to higher costs. So you can see how reactive the market is. The company's financials have been fine. Anytime there's news that's considered negative, people start selling off the stock. Anytime there's news that's positive, people start buying the stock. And it makes sense because people base their decisions on psychology, not financials, not facts. It did take about 3 months for people to start buying the stock again. So it does seem like it's trading at a good value right now. There's no reason the stock shouldn't go up. And if they start getting squeezed, they can just do what every other company does, raise prices. Here's an interesting chart. Mucinex is cold and flu medicine. States where masks are not mandated, sales have gone up for Mucinex. States that have mask mandates, sales have gone down. We don't know what states, they just call them state 1 through state 50. But the evidence is pretty glaring. States that wear masks don't need cold and flu medicine. States that do not wear masks need cold and flu medicine. Here's how some of their products grew the past year. Dettol, that's sold all over the world except the United States. But they show us a flag of India. That's probably where most of their sales come from for this product. That grew 900 basis points. BPS is basis point spread. 100 basis points is 1%, so this grew 9%. Lysol, 2%. Finish, another American product, 8%. Veha, a Brazilian product, 12%. Durex, they show a British flag, that's 32%. Nurofen, 3%, Gaviscon, 16%, Enfa, 16%, and another American product, 23% growth. They pay a semi-annual dividend. In May, it was 102 pence. In August, 73 pence. That's a 2.8% dividend yield. We cannot look at the payout ratio since they have negative net income from those large write-offs. But they pay out 75% of their free cash flow. It looks like a majority of their free cash flow goes back to the investors. Their industry pays a 2.6% dividend. They're a little higher than their industry. They have a really low beta, 0.14, so the stock doesn't move too much. It's flat the past 52 weeks, while the S&P is up 24%. The 52-week low was 4,900 pence. The high was 6,800. The stock is trading above its 50-day and 200-day moving average. A little over 1 million shares are traded each day. Of the 714 million shares outstanding, 710 million are on float, and 65% are held by institutions. They employ 44,000 people, and it seems to have gone up a bit in the past few years. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $22,000 today. That's an 8% annual return. Here's some of the insider buying and selling. 10,000 shares have been sold and 53,000 shares have been purchased. Here's more detail on the insider trading activity the past year. So lots of different people have been buying the stock, which is a good sign. Here are the number of shares they bought or sold, and here's the stock price. 87% of the shares are held by institutions and 12% by the general public. BlackRock is the biggest shareholder at 7.4%. 53 million shares valued at 3.3 billion pounds. Then MFS Investment, Morgan Stanley, Capital Research, and Vanguard. Let's look at their financial ratios. We can't look at the PE since they have negative net income. They have a good price to sales ratio of 3.3. That's stock price over sales per share. That means investors are paying $3.30 for a $1 revenue. They have a price to book of 6.8. That's stock price over book value per share. And the way you calculate book value per share is equity over shares outstanding. Equity is on a balance sheet. It's assets minus liabilities. They have 6.6 billion pounds of equity, negative 12 billion pounds of tangible equity since they acquire so many businesses. A really good return on invested capital of 15%. They can cover their interest payments 15 times. A negative ROE since they have negative net income. They can only cover 70% of their current liabilities with their current assets. And their quick ratio is 0.6. In the trailing 12 months, they generated 1.7 billion of free cash flow. They have negative 2.6 billion of working capital. Working capital is current assets minus current liabilities. And they pay out 1.2 billion of dividend payments. So they're going to be short 2.2 billion pounds. I wouldn't be too concerned because it's pretty easy for this company to get debt. They may need to add debt financing to get through the next 12 months. The best way to look at ratios to compare them to companies in the same industry. There are 30 companies in the same industry as Reckitt, and I converted all these market caps to pounds so everything will be equal. Reckitt ranks 5th in terms of market cap. Procter & Gamble is the biggest by far, then Unilever. Reckitt is still a pretty big company at close to 45 billion pounds. Their price to book is much better than average. We can't look at the PE. Their price to free cash flow is a little better than average, and their price to sales is a little worse than average. So their ratios are about average compared to the industry. So to summarize, I have them trading at a 19% discount, and this company has always been successful, but COVID boosted it up even more because of the demand for their products. Their cold and flu medicine, Lysol, all those types of products. The 3 original companies that make up this entity are 150 to 200 years old. So they've been around a long time, they know what they're doing, so I think it's fine for a long-term hold. Plus you receive that safe, consistent, semi-annual dividend payment. I rank their free cash flow as 5 out of 10, their revenue 7 out of 10, and their ratio is 4 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.